Hi everyone. Do you believe that the market, and specifically S&P 500 index, can predict the economy? Well, let's find out. Today we are diving into the fascinating connection between two powerhouse metrics in economics and finance, GDP and the S&P 500. GDP gives us a snapshot of a nation's economic performance, while the S&P 500 is a barometer of stock market health and investor sentiment. Together, they provide a unique lens through which we can explore trends, risks, and opportunities in the economy. Our goal here is to unpack the roles these indicators play, with GDP acting as a rear-view mirror of the economy and the S&P 500 offering a glimpse through the windshield. We'll explore how their relationship, whether they are aligned or are at odds, can guide decision-making, maybe predict market trends, and offer insights into broader economic conditions. Whether you are a seasoned investor or just you are curious about market dynamics, this session will provide valuable tools to better understand the economic landscape. Let's start with the GDP, which stands, of course, for Gross Domestic Product, essentially the total value of all goods and services produced within a country over a specific period. There are two main forms of GDP. The first one is nominal GDP, which measures this value in current dollars, and real GDP, which adjusts for inflation to give a clearer picture of actual economic growth. Economists tend to focus on real GDP because it's a more accurate reflection of changes in productivity and economic health over time. A quick note here: when real GDP shrinks for 2 consecutive quarters, it is officially labeled a recession. Now, on to the S&P 500, or SPX for short. This is a stock market index that tracks the performance of 500 of the largest companies listed on US stock exchanges. It is not just a measure of individual company performance, but a broader reflection of market sentiment and investor expectations. The S&P 500 often serves as a leading indicator, meaning it can provide clues about where the economy might be headed before the data on GDP becomes available. GDP and the S&P 500 serve very different roles in economic analysis. GDP is considered a lagging indicator because it reflects economic performance that has already occurred. It's derived from actual data like consumer spending, government investment, and industrial output, offering a historical snapshot of the economy's health. While invaluable for understanding trends and setting policies, GDP data often arrives too late to predict immediate changes. In contrast, S&P 500 is a leading indicator, which provides insights into where the economy might be headed. Stock market performance is driven by investor expectations and confidence, which means the S&P 500 often reacts to anticipated economic shifts before they appear in GDP figures. For example, companies' stock prices may rise in response to expected policy changes, maybe new technologies or global trends, and this happens long before these factors show up in economic reports. Well, understanding the dynamic between lagging and leading indicators is very crucial. While GDP validates past performance, the S&P 500 offers a forward-looking perspective. Together, they complement each other, providing a more holistic view of economic conditions and enabling better decision-making for policymakers, businesses, investors, and everyone else who is interested in markets. The relationship between GDP and S&P 500 is one of the most debated and analyzed topics in economic forecasting. While GDP provides a backward-looking view of economic performance, the S&P 500 acts as a forward-looking measure, often reflecting investor sentiment and market expectations before GDP data is even available. This difference in perspective makes their correlation particularly fascinating and valuable for interpreting market signals. Well, historically, quarterly S&P 500 closing prices, when lagged by 6 months, have shown a 70% correlation with US GDP. This suggests that movements in the stock market often anticipate changes in GDP, whether upward or downward. For instance, when both indicators rise, it generally signals a period of economic expansion, while a simultaneous decline in both points to a contraction or recession. Understanding the nuances of this correlation can be crucial for decision making. For example, when GDP increases but SPX declines, it might indicate a cautious or skeptical market outlook. And conversely, if the SPX rises and GDP declines, this optimism may stem from other factors, such as maybe future policy changes or expectations of a rapid recovery. Each of these scenarios demand a tailored strategy to navigate the economic landscape effectively. Analyzing the interplay between GDP from one side and the SPX from the other side provides crucial insights for interpreting economic trends. Here, I would like to share with you a GDP to SPX correlation indicator from my own pack of forward-looking economic analysis indicators. It is basically two bar charts representing GDP and SPX, which is lagged by 6 months. Green bars here indicate quarter-on-quarter growth, while red bars mean decline in the corresponding quarter. So, there are 4 scenarios that we will discuss here. Scenario A: when GDP and the SPX both rise, the correlation highlights a period of economic recovery or maybe expansion. This positive alignment boosts investor confidence and leads to increased stock investments. It often signals a good time to buy into the market, as growth prospects are reflected across both economic performance and market sentiment. On the chart, such situations are spotted by green triangles at the bottom. Conversely, when both GDP and the SPX fall simultaneously, this is scenario B, by the way, it typically reflects a period of economic contraction or sometimes even recession. This alignment serves as a warning sign, often prompting investors to adopt defensive strategies such as selling off higher risk assets like stocks. The red triangles at the top of the chart suggest that you may consider selling risky assets. However, the scenarios where GDP and the SPX diverge demand careful interpretation. For example, in scenario C, when GDP is up but the SPX falls, it could indicate market pessimism despite a growing economy. External factors such as geopolitical risks and maybe tightening monetary policies or maybe reduced corporate earnings expectations might explain the disparity, leading to cautious investment strategies. Again, red triangles at the top point at such divergences. On the flip side, if GDP declines but SPX rises, as it is in scenario D, it might reflect speculative optimism or expectations of an imminent recovery. Such a mismatch introduces uncertainty, making it prudent to stay neutral or maybe reduce exposure to volatile assets. This caution on the chart is indicated by gray arrows, suggesting that it might be the right time to stay flat. Understanding these scenarios helps investors and analysts navigate complex economic landscapes with informed strategies. So in order to backtest these four scenarios and demonstrate the correlation between these two indicators, I have written a small piece of code that translates this notion into a strategy. The initial capital invested into the strategy back in 1970 is $100,000, and all of the gains are reinvested back into the SPX ETF. This strategy buys SPX whenever both GDP and SPX, which is of course lagged by 6 months, are up, and sells the equity whenever the remaining three scenarios are true. Throughout the last 55 years, the strategy completed 43 trades with total profitability of 1,500%, or the equity equaling to $1,500,000. So, is it a good strategy to use? Well, comparing to the simple buy and hold strategy, it is not that efficient. However, the point here is to demonstrate the positive correlation between GDP and the SPX lagged by 6 months as a proof of the concept, and highlight why it is important to be mindful of divergences. While GDP serves as a reliable measure for historical performance, it cannot capture the forward-looking expectations that drive the financial markets. Relying solely on GDP to make investment or even policy decisions can lead to missed opportunities or delayed responses to economic changes. Its value lies in validating trends and understanding structural shifts in the economy. The S&P 500, on the other hand, offers a pulse on the market's expectations and confidence. Its forward-looking nature makes it dynamic, but at the same time very volatile indicator. While it can signal potential economic recoveries or downturns before they materialize in GDP data, its movements are also subject to external influences, such as monetary policies or global events, that may not reflect underlying economic conditions. By integrating insights from both GDP and the SPX, a more nuanced and accurate economic outlook emerges. This approach acknowledges the lagging and leading characteristics of these indicators, allowing analysts, policymakers, and of course, investors to make balanced decisions based on a broader range of data points. Looking back at the relationship between GDP and the SPS, we see that their combined analysis offers powerful insights into economic trends. While neither metric is flawless on its own, their interplay provides a more robust foundation for understanding market dynamics and economic health. This reinforces the importance of using diverse tools in economic forecasting. One of the key lessons here is the value of perspective. Lagging indicators like GDP are invaluable for validating what has already occurred, helping us make sense of structural trends and long-term shifts. Meanwhile, leading indicators like the SPX provide a glimpse into future possibilities, influenced by sentiment and expectations. Together, they balance the scales between past and future. As a wrap-up, remember that interpreting economic data requires context and caution. Always consider the broader landscape factors like global events, policy changes, and technological advancements that can influence these indicators in unexpected ways. By staying informed and open to multiple perspectives, you'll be better equipped to navigate the complexities of the economic world. Thank you for watching, and see you in the next episode.